Howdy, Jacob here. Today we're looking at F5 Networks in the communications equipment industry, 15.2 billion market cap on 14.1 billion enterprise value. So on that, it looks like they have a lot more cash on hand in comparison to their debt. They provide multi-cloud application security and delivery solutions worldwide. The company's distributed cloud services enable its customers to deploy, secure, and operate applications in any architecture from on-premises to the public cloud. Company is formerly known, incorporated in 1996. Growth is not crazy quick, but does look to be very consistent. So we do see 2 years where revenue jumped pretty heavily, about 10%, but outside that, it's been very consistently between 3 and 5%. Their gross margin and operating margin are down a little bit from 10 years ago, so that's not as positive, but they do have a very, very good return on invested capital. Looks like their R&D is about 500 million in relation to 2.8 billion in revenue. And so that is going to be a little less than 20%, a little over 15. So you're between 15 and 20% of your money is going to from revenue is being expensed as R&D. That's a pretty substantial amount. So that's taking a lot of money away from today to hopefully make more in the future, hopefully become more efficient. And the fact that it's up quite a bit from 10 years ago is definitely a positive sign. So not all of that money will likely turn into excess earnings and bottom line, but hopefully a good amount does, and find new opportunities to reinvest back into yourself. So that's positive. They have over $1 billion in cash on hand with no short-term debt, no long-term debt, just a little bit of capital leases. So gorgeous balance sheet. Cash flow statement shows good production of free cash flow with CapEx very inconsequential in relation to cash from operations, and majority of their money is going to share repurchases. A little bit of money to acquisitions, reinvestment, debt pay down, but a lot of it is going to share repurchases. So I think that's enough to get me to make some assumptions. On the revenue growth side, I think I'd be pretty comfortable with 5%. It's pretty consistent with what they've done historically, and that's saying that a little bit of money goes to acquisitions. Otherwise, they just increase their business with inflation. I'm not terribly concerned with that. For margins, the last couple of years, we're averaging about 15% on the net income side, but then a lot higher on the free cash flow side. But they have increased that net income margin. So let's go about 20 here. Let's go about 22 there. Share change, a lot of their money going to share repurchases. If we net out, assuming all stock-based compensation gets turned into shares, which isn't guaranteed, but is a conservative estimate, we're looking at net about 300, 400 million. And that should be about 2% of shares. So let's assume 2% share reduction. Terminal P and price of free cash flow with good return on invested capital business, but most of their money to share repurchases, not necessarily all being reinvested back into the business. Good operating margin, but down from 10 years ago, and same with good gross margin. 80% is fantastic, but down a little bit from 10 years ago. I'm probably comfortable with a 17 P in price of free cash flow and a 15% return, and it's needing to fall 60% before you get the return like for here. So not every metric is coming up as showing this is a fantastic company, but most are. I mean, great return on invested capital, good consistent revenue growth. The margin declines are something I don't like, but if we look at the stock analysis based on price, it's definitely not at a price point that I'm going to be doing research anytime soon. But I do hope you enjoy this video and have a great rest of your day. Thank you.